$360,000. That is roughly what 15 years of interest costs you on a $400,000 mortgage, at the rate lenders are quoting in 2026, and $1.28 million. That is what the same $400,000 would have added if you had left it in a broad index fund for 15 years at its long-run average, instead of burying it in a roof. Put those two figures side by side, and the decision looks finished before it starts. Take the loan, keep the money compounding, win by about $900,000. That number is wrong. Not a little wrong. Wrong by about 2/3. And the reason it keeps circulating is that the version of this comparison people repeat has two holes in it, one of which makes the mortgage look worse, not better. You are the one holding the cash and a signed purchase contract. So let me take it apart. Here are the rules, and I am not moving them once they are set. The same house on both sides, $400,000, a normal American price. The median existing home sold for $434,100 in July of 2026, according to the National Association of Realtors. So this is not an exotic property. Path A, you write the check. Path B, you finance $400,000 on a 30-year fixed at 6.65%, which is what Freddie Mac reported for the week ending the 20th of August, 2026. And I will run the math at 6.6 for round arithmetic. The $400,000 you did not spend goes into a broad index fund at a 0.03% expense ratio, about $120 the first year. No refinancing, no renting it out, no selling early. 15 years, then both sides liquidate on the same morning. And if your real loan is smaller because you put money down, every dollar figure in this video shrinks proportionally, and the conclusion does not move an inch. The scale changes, the mechanism does not. Path A first. The check clears, the deed records. You own a $400,000 house free and clear, and you have the best housing costs in America: property tax, insurance, maintenance, nothing else. Now, look at what that $400,000 does the next morning. It earns the house. That is the entire list. No dividend, no statement, no line on a balance sheet that moves. It does not underperform because there is no benchmark printed anywhere that it can fall behind. To touch a dollar of it again, you either sell the house or borrow against it at whatever rate the bank feels like that year. That is an opportunity cost, and it deserves a number, so let me give it one. On the subject of long horizons and fixed obligations colliding, I wrote a digital book called The Exit Code that runs the same kind of arithmetic across a full retirement, and the link is in the description if that is useful to you. Back to the house. Path B. $400,000 at 6.6% over 30 years is a principal and interest payment of about $2,555 a month. $2,555, 180 times, whether you feel like it or not. 15 years of that is about $460,000 out the door. Now, the part that makes people quiet, of that $460,000, only about $105,000 touched the principal. Roughly $355,000 was pure interest, paid for the privilege of not liquidating your portfolio. And after 15 years of never missing a payment, you still owe about $295,000 on a house you have been living in since 2026. Amortization is front-loaded. The bank collects its rent first and your equity later. So here is the scorecard, as it usually gets printed. Path B's $400,000. Compounding at 10%. Roughly, the long-run nominal average for large American stocks would have become about $1.67 million over 15 years. That is $1.28 million of growth against $355,000 of interest, a gap of about $915,000 in favor of the mortgage. $915,000. That is the number driving every compounding chart on this topic, and it has two holes in it. Two, not a vague list of caveats, two specific arithmetic failures, and I am going to close both of them right now, starting with the one that cuts against the borrower. Hole one is the mortgage interest deduction, which people assume quietly discounts the rate. Run it. Year one interest on that loan is about $26,000. The standard deduction for a married couple filing jointly in 2026 is $32,200. 16,100 filing single. So a married couple with $26,000 of interest, plus state and property taxes capped, plus whatever else, most of them still land under the standard deduction, which is why roughly 5% of taxpayers itemize at all. Meaning your interest cost is not 6.65% minus a tax haircut. It is 6.65% full price printed on the note. Every argument that starts with "but the write-off" dies right there. Hole 2 is bigger and it runs the other direction. The cash buyer has no mortgage payment, which means that $2,555 a month is not spent, it is available. Invested every month at the same 10% for the same 180 months, and it becomes roughly $1.06 million. The cash buyer was compounding the whole time. People forget this because the freed payment does not feel like an investment. It feels like relief. So rebuild both columns, honestly. Take path B first. The account holds $1.67 million, and the house behind it still carries a balance of $295,000. Subtract one from the other, and path B nets about $1.375 million. Now path A, same house, paid off, plus 15 years of redirected payments, about $1.06 million. The house is identical on both sides, so it cancels. The gap is about $315,000, not $915,000. $315,000 over 15 years before tax. Take a second with that, because it just cost the mortgage side 2/3 of its lead. And by the way, if you find this kind of thing useful, clicking subscribe genuinely helps the channel, thanks to everyone who does. Now, what is that $315,000 actually made of? It is not magic, and it is not leverage in the exciting sense. It is the spread between roughly 10% and 6.6% earned on a loan balance that shrinks embarrassingly slowly. That is the entire paycheck. You borrowed $400,000 at a known price and rented it out to the stock market at an unknown one. Everything else in this comparison, the house, the taxes, the insurance, the roof, is identical on both sides and cancels out. Which means the whole decision reduces to one question. Does the index rate clear the note rate? And that immediately raises a colder one. 10% is an average, not a delivery guarantee. So run the bad case. The worst 15-year stretch in the historical record for large American stocks returned about 3.7% a year. Not a crash, a long, flat, demoralizing grind. At 3.7%, your $400,000 would have grown to about $685,000, and you would still owe $295,000, netting about $390,000. The cash buyer's monthly payments at that same 3.7% would have accumulated to about $613,000. Cash wins by roughly $200,000. Now run the median 15-year window, which historically has been about 10.3% a year median, meaning half of all 15-year stretches did better and half did worse. There, the mortgage wins by about $315,000, as we calculated. So the honest answer is not a verdict, it is a range. Mortgage up $315,000 in the typical case, cash up $200,000 in the ugliest one on record. Somewhere between those two returns, the two columns cross. The crossing number is about 6.6%. Run it, and the tie is visible. At a 6.6% index return, your $400,000 becomes roughly $1.04 million, minus the $295,000 you still owe, leaving about $750,000. The cash buyer's $2,555 a month at that same 6.6% accumulates to about $780,000, within a rounding error of each other on a 15-year horizon. And once you see why, it stops being a coincidence. Taking a mortgage is selling a bond to your lender at a coupon you agreed to. The hurdle rate on borrowed money is the price of the money. So the crossing number was never hiding in a market model. It is printed on page 1 of the loan estimate you would sign. 6.65% this week. Except the printed number is not the real hurdle. And this is where I would be careful. Everything I have quoted is before your personal taxes. The mortgage path ends with a taxable brokerage account you eventually sell out of. The cash path ends with a house and a smaller taxable account. The tax drag is real. It depends on your bracket and your state, and I am not going to pretend I can compute yours. What I can tell you is the direction. It raises the bar. If you want an honest margin of safety, judge this trade against something meaningfully above the note rate, not at it. Call that a margin of judgment, not a research figure. And kill the appreciation argument here, because it does not belong in this comparison at all. You own the same house either way. National home prices have run in the mid 4% range nominally over the long run, closer to 1 or 2%. After inflation, there was a 17.4% year-over-year burst measured during 2021. And annualizing that is how people talk themselves into things. But none of it matters here. Appreciation lands on both columns identically. The only thing moving is $400,000 and how it is treated, which brings up the variable that has nothing to do with rates. You are not 34. 180 payments starting at 62 ends when you are 77. Starting at 65, you are making a $2,555 payment at 80. A mortgage converts a flexible expense into a fixed floor, and floors are exactly what hurts in retirement. In a bad market year, the paid-off household cuts travel and waits. The mortgage household sells shares into a decline to make a payment that is due on the 1st, regardless of what the market did in March. That is sequence of returns risk with a due date attached. To be fair, the cash buyer has the mirror image problem. $400,000 sitting in the walls is unreachable without a sale or a home equity line at a variable rate you do not control. Equity is not cash. It is cash you have to negotiate for, usually at the worst possible moment. Which is why pay off the house before you retire being repeated as a universal law bothers me. It is repeated by people who never ran the second column, who never once asked what the freed payment does over 180 months. And the 4% rule quietly assumes a spending number that a $2,555 payment inflates for 15 straight years. As for the advisor charging 1% a year, watch the incentive rather than the person. Paying cash for the house removes $400,000 from the assets they bill on. Most of them will still tell you it is a personal decision, which is diplomatic and not the same as arithmetic. Nobody here is lying to you. They are answering a question that the fee structure makes awkward, which is exactly the mechanism I built the exit code around. Withdrawal math breaks in the years when a fixed obligation meets a falling portfolio. And that is not a scenario the standard retirement calculator models. It averages straight through it. The book runs 50 years of actual retirement data, not opinion, through two things that matter here. The 4% trap, which is where a static withdrawal rate quietly fails when the sequence goes against you early, and the dynamic withdrawal method that replaces it, which sets your spending from what the portfolio actually did rather than from a rule of thumb published in 1994. 8 chapters, no filler. It costs less than a dinner out through the link in the description. And the reason I mention it now is that the second gate of this housing decision runs on precisely that math. So here's the test. 3 gates. Gate 1, the rate gate. Do you believe 15 years of index compounding clears the number on your loan estimate with real margin, not by 1/10 of a point, but by enough to absorb taxes and a bad decade? 6.65% is a high hurdle by historical standards, and you have seen what happens at 3.7%. Gate 2, the payment gate. Can guaranteed income pension, Social Security, an annuity, a salary you are certain of cover 180 payments without you selling equities in a down year? Not on average. In the bad year. Gate 3, the behavior gate. Will that $2,555 actually get invested every single month for 15 years? And will you hold through a 40% drawdown while owing $295,000 on the house you sleep in? Fail any one of the 3 and you write the check. Pass all 3 and the note is defensible. Watch what that does to 2 versions of you. Version 1 has a pension plus Social Security that covers the payment with room to spare. And the portfolio is never touched for housing. Rate gate, arguable but survivable. Payment gate, clean. Behavior gate. This person has been investing through drawdown since 2008. All 3 pass, and the roughly $315,000 is theirs to take. Version 2 draws every dollar of income from the same portfolio that is supposed to out-earn 6.65%. That is the same money doing 2 jobs. Gate 2 fails, And the $300,000 they give up is the honest price of a payment they never have to make in a bad year. That is not a loss. That is insurance, correctly purchased. And it is not binary. 200,000 down splits, every gate proportionally smaller floor, smaller spread, smaller consequence, either direction. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. If subscribing sounds worth it for more of this, I appreciate everyone who does. So the gap is about $315,000, not $900,000. The crossing rate is the rate on your own note, 6.65% this week, and you should demand margin above it, not equality with it. And whether you can take that trade at all is decided by whether guaranteed income covers 180 payments during the worst 3 years of your retirement. The reason the cash decision loses quietly, when it loses, is that a buried dollar never sends a statement. It never shows a red number, never trails a benchmark, never appears in any account you check. Nothing you refuse to measure ever looks like a mistake. One path buys you a smaller outcome that is certain. The other buys a larger one that is probable, with a bill due on the first of every month for 15 years. You are the one who knows which of those you can actually hold.